Hi everyone, welcome back to my channel. This is my usual weekly technical analysis outlook videos in which I will comment on what I think will happen to some FX crosses and equities. As always, before I begin, I want to clarify that this is not a solicitation or recommendation to enter into long or short positions in the names that I will mention in this video, nor do I have existing positions in them. This is not financial advice, and if you're using this content as a guide to trade, you are doing so at your own risk. Alright, let's start. These are the names that I have covered in previous videos, and I will do a quick review on each of them. Also, I will cease coverage on these names because their chart patterns have been invalidated or did not perform up to expectation. I have put in timestamps, so please use them to skip to the names that interest you. In a video on the 22nd of November, I said that Danaher is in the bullish resumption phase of its head and shoulders bottom. It has since advanced further and remains on track towards the textbook target of 261.23. In a video on the 28th of December last year, I stated that Apple is technically bearish due to the completion of a rising wedge on the 15th of December. The textbook target of this rising wedge is at 253.83. Apple over here fell to a low of 255.70 on the 8th of January, reaching 92% of its textbook target. I will maintain coverage on this name just to see if it reaches the textbook target. But I expect the next move for Apple to be higher first, at least for 1 to 3 sessions, due to correcting the lower Bollinger overextension, after which downside is expected to resume. I started coverage on Tesco in a video on the 13th of December last year and highlighted a potential head and shoulders top. This bearish pattern was completed on the 8th of January and the textbook target is at 388.8. But I expect Tesco to soon enter the correction phase and could rise to around 488.3 before resuming the downside. Now, two reasons for this. First is the lower Bollinger overextension, which usually leads to 1 to 3 days worth of rebound. Second, there was a gap down over here on the 8th of January. My view is that gaps are usually, though not always, partially or fully filled. There are a few dollar crosses that I will cease coverage on, starting off with the dollar index. I last updated on 1st of November that the dollar index is bullish, as falling wedge is still valid and may be forming a double bottom, another bullish pattern. Now, price action has developed in such a way that it no longer fits a double bottom. I also think that price action is taking too long to rally after the falling wedge has completed, so I prefer to cease coverage on the dollar index and deem both bullish patterns invalid. I will cease coverage on dollar Swiss. Even though the falling wedge has not been invalidated, price action has largely been sideways since this pattern was completed and doesn't fit how a bullish pattern would normally work. I will also cease coverage on dollar Sing. There was a double bottom that was completed in November, but dollar Sing has since fallen and closed below the Ichimoku cloud. Therefore, it no longer fits a bullish outlook narrative. Moving over to equities, I will cease coverage on PepsiCo. The head and shoulders bottom that I began highlighting on the 18th of November last year did not see completion and was instead invalidated this week. I will cease coverage on Standard Chartered as well because the rising wedge was invalidated after price action broke above the resistance trend line. Finally, I will cease coverage on Reckitt Benckiser because the rising wedge was invalidated after price action broke above the resistance trend line on the 19th of December. That's the end of my sharing. I will give updates to these crosses and names only when there are meaningful development, and in the next video, it will highly likely be on new crosses and new names. If you like what I'm doing, please help me out by giving me a like. Please subscribe and hit the notification button for more videos like this.